Hello and welcome back. This is David from the Personal Finance Squad.
Okay, now we're going to get into the 13.2 section, which is a Roth IRA. Now we can see right here that a Roth is also called a backloaded IRA, but you do not need to know that. As long as you say I have a Roth, then everybody knows what you mean. Now a Roth is an individual retirement account, but it is different because there is no pre-tax. It's all based on after-tax income. And it has a limit like any other retirement type of plan. Now the difference with the Roth to that of a traditional IRA is that contributions are not subject to a tax deduction. And they can be withdrawn at any time on money that was deposited, but not on interest without penalty. So any earnings you make, so if you put $1,000 in here, just for example, and you made $300 on that, right now your account would be at $1,300. Now if you took that $1,000 out, you're fine, but if you take anything of that $300 here, that section is subject to penalty, depending on the rules. So let's look at the rules. Just like the other accounts, 59.5. And mandatory withdrawals at age 70 are exempt. So if you take money out before 59.5, then you could be subject to penalty. Now contributions to a Roth are permitted for people who make under 117 grand and are phased out after 132. Now this is based on 2016. You will always have to check and see what the rules are because they all have setups, just like you see in the chart here. And we've talked about this in other chapters. We talk about the modified adjusted gross income is taking your earnings and then taking anything off for deduction, such as a standard deduction, such as interest on your home, things of that nature for a dependent child, things like that will reduce that tax amount. You're always trying to reduce the amount of tax you have to pay to the government so that you can hopefully get a return or break even. You're trying not to owe unless you have to put money away on your own to account for that. But that's the idea of knowing what adjusted gross income is. You want to know how much money can I get off my taxes. So they'll sit there and say, okay, well, you need to look here and determine where do I stand in this chart. So we have a filing status here, and you can see right here that, let's say you're married and you're filing separately. So your income limit is greater than $10,000. You can't even have a Roth IRA. Now, if you're single and you make less than 117 grand, you can put in $5,500. If you make less than 184 filing jointly, you can put in $5,500. But you can see there's phasing out. 183 to 189 begins to phase out. 194 or more means ineligible. Then down here, for example, you can see if you make over $132,000, you're ineligible. Now you could get something called the backdoor IRA, and we'll have another chapter on that. But for now, these are the types of things you need to look at if you're choosing to have a Roth. You also see right here, catch-up contributions for people over 50 and older. An additional $1,000 can be put in for a total of $6,500 as long as you qualify to have a Roth IRA. Okay, now let's get into the section 13.3, which is withdrawing Roth contributions. And so we talk about rules, and Roths have a rule to be able to take money out that you'll pay tax on unless you follow a two-part test. Okay, so Roth is technically a 5-year deal to be able to take money out like as such for certain things. So the way you want to look at it is, as long as you hit 4 calendar years, you're good. So it's a little way to cheat around it. So you can say right here, for example, if you opened a Roth on August 1st, 2017, and you took payouts on January 1st, 2022, it is really only 53 months. But you got it into the 5th calendar year. And you should see right here that it says you can contribute your IRAs up to April 15th in the calendar year following the actual tax year. So if you ended 2015 in December, and you could actually contribute in 2016, April 15th, for this tax year here. So it allows you to bump around and get around it. Now the other thing in the test is the second part. And to receive qualified distributions tax-free, withdrawals must be made after your death, so if you're not around, it won't matter. After age 59.5, made after you become disabled, made to help buy your first home as well as your spouse, kids, etc. So they give you some reasons that you can do some of this. And this is why people do like Roths. So let's look at the graph that the squad has put in here so we can just do a really quick understanding here. Okay, so right off the bat, is there a reason for a qualified distribution? Now, the answer is yes. Is the 5-year rule satisfied? So above we said yes it was, and that means you can take out money tax-free, penalty-free. Now you're saying, you know what, in this case, let's flip it over and say, no, I don't have that. I don't have a qualifying exemption. So I'm not meeting the rule, and therefore, because it's before 5 years, and I haven't met any of these things up here, if I take money out, I have to pay my ordinary income plus 10% penalty. So you really have to look at this and decide, how would this happen to me? And you can see here, we've always talked about these retirement type plans. You do not want to take money out unless you have to in order to break a rule, because breaking a rule is just not worth the money that you put in and accumulated to take it out. It's such a detrimental thing to do. You should only do it if you are in dire straits. Otherwise, find other ways, other avenues to be able to take money out. Now, we do want to look here and say, what are some exemptions to the 5-year penalty? Just keep in mind, once you've reached that 5 years, you're good to go. But there are circumstances where people are in dire straits and need help, and they must do this. So you can see right here, these are situations that are pretty unavoidable, and people are going to need extra income because they may not have it from other places. So you can see right here, unreimbursed medical expenses that exceed 10% of your adjusted gross income. So that means you might be swimming in medical bills and need to get those down. You have insurance premiums after losing a job, and that can mean a lot of money to pay for insurance, especially if you're going on COBRA or getting it on your own or going through Obamacare or something like that. It can be expensive. We know healthcare never goes down in cost. Distributions for higher education. You have an IRS levy, and certainly if you're getting levied by the IRS, they're going to continue to tax you. You can see military service over 180 days, and then we can see these two related to disaster recovery. So again, we always say if you can avoid doing this, then you should, because it's your retirement. Okay, so that's going to cover it for this chapter, and that means we are done with the Roth IRA, and we will see you in the next video. Thanks for joining.